Hi there, everyone. Good afternoon. Thank you so much for joining us today. I'm Nancy McClernand, and I am President and CEO of the Global Business Alliance. I'm so pleased to be partnering with the Institute for International Bankers on this new economic advisory series that we're launching today with Mizuho Bank. So as many of you know who have signed on here, the Global Business Alliance is a trade association representing approximately 200 international companies doing business in the United States. Our members include companies from a very wide variety of industries, including manufacturing, retail, and the financial sector. Companies like Toyota from Japan, Nestle from Switzerland, Siemens from Germany, and Michelin from France. You can find all of our members and more information about our organization on our website, which is globalbusiness, which is all one word, .org. Altogether, foreign companies in the U.S. directly employ nearly 8 million Americans, and perhaps counterintuitive to some, these companies are actually leading the way in Made in America, having created 69% of all new manufacturing jobs over the last 5 years. Within each and every area code around the country, these American companies that were founded abroad and now have major operations and employment are doing business here in the United States. Each quarter, both the Global Business Alliance and the Institute for International Bankers will be bringing to you a prominent economist from some of the world's top banking institutions to share the latest on key macroeconomic issues. Given the extraordinary shifts in the US and global economies since the onset of the pandemic, we aim to provide expert information and unfiltered, practical analysis critical to finding effective policy solutions. So now I'd like to turn it over to my colleague at the Institute for International Bankers, Megan Malloy. Megan, hi, good to see you.
Hi, Nancy. Thank you for having me, and thank you so much for partnering with us on this. The IIB echoes your excitement about the launch of our Economic Advisory Council. Our associations are lucky to have such a wealth of knowledge and expertise within our memberships, and I think, and I know that you agree, it's high time we share that with policymakers in Washington and beyond. For those of you that I haven't yet had the pleasure to meet, I'm Megan Malloy. I am the Director of Strategic Communications here at the Institute of International Bankers. We represent the US operations of nearly 90 internationally headquartered banks of varying sizes, portfolios, geographic reach, and clientele. Our mission at the IIB is to ensure that policymakers are aware of the significant contributions our members make to the US economy and to the communities and markets in which they operate. We also strive to help to resolve the legislative and regulatory issues facing our members in the United States. Through our advocacy efforts, we seek results that are consistent with the US policy of national treatment, a level playing field, and that appropriately limit the extraterritorial application of US laws to the global operations of our member institutions. Today, in partnership with the Global Business Alliance, we are thrilled to host the chief economist of one of those member institutions who will share his assessment of the post-pandemic economic trajectory. We've all heard debates on whether we'll have a U-shaped or a V-shaped or even a K-shaped recovery, and whether inflation is likely to abide or to soon subside. Steve Ricchiuto, Managing Director and Chief Economist of Mizuho Securities USA, will give us his thoughts on those questions. As Chief Economist, Steve is responsible for formulating and marketing the firm's macroeconomic and interest rate forecast and providing clients with a strategic outlook on the US economy and financial markets. Prior to joining Mizuho, Steve worked at Svenska Handelsbanken and at ABN AMRO, two more IIB member institutions, where he was chief economist and head of fixed income research for the region. He has more than 35 years of experience in the financial services industry. Outside of his time spent dedicated to the GBA and the IIB, Steve is a well-known and highly regarded economist with extensive appearances on various business, news, television, and radio programs, and is regularly quoted in the print media. His latest book, Disequilibrium: How the Great Inflation Caused the Great Recession, was published in January 2017. So I'm sure many of you are familiar with Steve, and if not Steve, certainly with his work. Steve, thank you so much for joining us today to kick things off with the Economic Advisory Council. We're thrilled to have you, and frankly, quite lucky to have you both today and with the IIB in general. And we look forward to learning quite a bit. So Before I turn it over to David Landers, who is Mizuho's head of U.S. government affairs, to further introduce the conversation, I just want to strongly encourage everyone tuned in today to take advantage of the Q&A function in the platform. We've reserved about 10 minutes at the end of the remarks to answer any questions you may have, so please make sure to send them our way. So without further ado, David, the virtual floor is yours.
Thank you, Megan, and it's a great pleasure to be here in partnership with our two fine trade associations, the IB and the GBA. Again, I'm David Landers. I'm the head of U.S. government affairs for Mizuho. And before I turn it over to our distinguished expert, our chief economist, I want to just talk for just a second about Mizuho, just so that you have a better understanding of the bank and hopefully can turn to us as a resource. Mizuho Americas is part of Tokyo-based Mizuho Financial Group, one of the largest banks in the world, with more than $2 trillion in assets. In 2016, we established the Mizuho Americas Bank Holding Company to optimize our business model to better compete in the region. In 2019, we completed a multi-year initiative to fully align our bank and securities businesses into an integrated corporate and investment banking structure, realizing internal collaboration and product synergy. As a result, we are in growth mode and expanding the product line and attracting top industry talent. It's a very exciting place to be right now. Year to date, we are a top 5 provider of U.S. project finance, top 10 in U.S. investment grade debt capital markets, top 10 in U.S. investment grade loan capital markets, top 15 in U.S. leverage capital markets, and top 20 in U.S. equity capital markets. We are a leading provider of a broad range of financial services, including lending, custody, treasury services, research, and capital market solutions. With offices across the U.S., Canada, Latin and South America, Mizuho Americas supports clients, institutional investors, and a public sector organizations by connecting local markets to a vast global network. In the U.S., we are headquartered in New York, with offices also in Atlanta, Boston, Chicago, Dallas, Houston, San Francisco, and here in DC, where I'm located. So I know that you will find Steve Ricchiuto's comments very enlightening today. Steve is, of course, a very distinguished chief economist of Mizuho, and I'm looking forward to hearing his comments as well. I just hope that you will feel free to reach out to either Steve or myself if we can ever be a resource going forward. There'll be a slide, I think, at the end with our contact information. And with that, let me turn it over to Steve. Steve, it's all yours.
Thank you, David. And previously, thank you to both Megan and Nancy for their very, very kind introductions. From my perspective, I think what we need to talk about today are both a combination of short and long-term dynamics. And typically, I like to provide one specific view to clients. I don't like to do the two-handed economist routine. It's a very, very difficult environment for people such as yourselves, and it makes a very, very complicated mess of the macroeconomic forecasting. But in this particular environment, there are really two major sets of underlying criteria that are dominating the economic outlook. There is a very, very cyclical short-term dynamic, and there is a very, very long-term deflationary dynamic that are both taking place simultaneously. And the net result of this has been a flattening in the yield curve for Treasury securities, in particular those between the 2-year note and the 10-year note in the Treasury bond market. This flattening of the yield curve environment is a function of expectations of additional monetary policy moves towards reducing accommodation coming down the pipeline, but it's also a function of a belief that there is an underlying inflation dynamic that's being generated as a result of some very short-term cyclical problems that need to work themselves out and will take quite some time to work themselves out. And as a result of that, we have this short-term dynamic of a flattening of the yield curve that then is leading with higher interest rate expectations at the front end of the curve, leading to an equity market which has been tracking sideways for the past several months. And the real question is whether or not we're going to get a correction or whether or not we're going to get an upward movement as we go into the 2022 period. Let me just talk a little bit about our interest rate forecast and then go back in and talk about those short-term and long-term dynamics, the short-term cyclical dynamic and the long-term deflationary dynamic, and how they then come back and net to our forecast. Our outlook for the U.S. 10-year note for the end of this year is 150. Now we're dealing with 165 right now on the 10-year note, so I believe we'll probably have a little bit of a downward adjustment in the 10-year note as the balance of this year progresses. What is my forecast for 2022 year end on the 10-year note? It's 1.75%. So we do not anticipate much additional upward movement in long-term interest rates as this year progresses and as next year progresses. So that's a very, very staid interest rate environment for an economy which has already gotten back through the recession and the recovery and is now technically in an expansionary phase. That's a very, very stable short-term, long-term interest rate environment. The short-term interest rate environment we're anticipating is also very, very benign. We do not believe the Federal Reserve will be raising rates until 2023, at the end of 2023 at the earliest. However, don't think that doesn't mean markets are going to anticipate the Fed will raise rates aggressively in the period ahead. We believe the markets will be looking for the Fed to begin raising rates in 2022. And right now, when you look at the 2-year Treasury note, it's priced basically for 2 rate hikes in 2022 and additional rate hikes in 2023. We believe between now and the end of this year, additional 2022 rate hikes will be priced into the market, and they will be priced in earlier than are currently priced in. People are expecting the interest rate increases to dominate in the second half of 2022. I would not be surprised by the end of this year to see one of those rate hikes being put in the second quarter of 2022, implying a first half of 2022 rate hike before the Federal Reserve even completes its tapering process of its large-scale asset purchase program. What happens when we have this rising short-term interest rate environment? It creates a stronger currency. Why? Because against the global economy, where the virus is still more important than the vaccine, against the global economy where there are strong fundamental deflationary pressures, where central banks are not moving as aggressively, the major central banks, i.e. BOJ, i.e. the People's Bank of China, i.e. the ECB, are not going to be moving as aggressively as the Federal Reserve in expectation. And that is going to drive up the US dollar. And as it drives up the US dollar, that higher short-term interest rate expectations will both result in a lower long-term interest rate environment and a flatter curve. And it's that combination of a flatter curve, higher short-term interest rate expectations, and a stronger currency that leads us to an environment where we still believe there's a possibility of a consolidation in the equity market before the end of this year. What does that imply about the equity market going forward? Well, we still believe the equity market in 2022 will end the year at around 4,900, which implies another strong year of equity gains in 2022. Now, how do we get to these interest rate and market forecasts? As I discussed, we have an environment in here in which basically we have a lot of short-term dynamics, which we've all seen and discussed over and over again in the financial press. And I'm going to get through them very, very quickly, because the real important point where we really differentiate ourselves from everybody else on the street is the longer-term discussion we're going to have after we discuss the short-term cyclical dynamics. What are the short-term cyclical dynamics? We have an economy where we have thrown $5.4 trillion in fiscal stimulus at it. Think about that. $5.4 trillion between the CARES Act and the American Recovery Act. $5.4 trillion thrown into an economy within a 1-year period of time. That means essentially we have added to nominal GDP, in addition to the normal trend line in nominal GDP, we've added an extra 18.5% to nominal GDP. We've expanded the Federal Reserve's balance sheet to buy all this debt by 105%. So in addition to the strong accommodation, the strong fiscal accommodation that was used to counter the COVID-19 lockdown mitigation strategy, we also have a Federal Reserve that's fully supporting this dynamic by buying all the Treasury securities created to fund the COVID-19 relief. So it's a very, very accommodative monetary policy. That accommodative monetary policy, that accommodative fiscal policy essentially created a short-term cyclical excess supply situation. Why? Because the vaccine became more important here than the virus more quickly than it did in other parts of the world. So as our demand picked up, the production to feed that future demand could not pick up. And there, of course, were all the logistics concerns in terms of the problems with freight deliveries, the problems with containers being in the right locations at the right time, the problems that we've seen develop in the ports. Essentially, we're dealing with a very short-term cyclical excess supply environment. That's been reflected in a very, very aggressive improvement in the labor market. We've seen the unemployment rate spike to as high as 14.8% during the COVID-19 lockdown mitigation strategy, and it's come all the way back down to 4.8%. Remember, prior to the COVID-19 lockdown environment, the unemployment rate had gotten to 3.5%, but more importantly, the Federal Reserve's estimate of the long-term trend for the unemployment rate is 4%. So essentially, we've come almost full circle in terms of the labor market environment. Yes, I know there's still 5 million additional workers who had jobs prior to COVID who haven't been reemployed yet. 100% correct. Unfortunately, a lot of those jobs may be in different locations than the workers are right now. It could also be that a lot of those jobs have also disappeared as a result of COVID and will take quite some time for them to come back. So I think where the unemployment rate has had a very, very sharp recovery, it is going to take longer for the labor market environment in terms of employment to recover. However, because we have this cyclical excess supply problem, we have created a cyclical inflation problem on the backdrop of this. And this Federal Reserve, following in the mantra of all Federal Reserves since Paul Volcker, have opted to focus in particular on a preemptive style of monetary policy to avoid a sustained rise in prices. This is a critical understanding point. This is a critical point in terms of the future of the economy and the future of monetary policy. This Federal Reserve, whether you look at the hawks or you look at the doves, they are moving increasingly in this preemptive program where inflation is remaining more persistent than we had seen, and where we're starting to get evidence of a tightening labor market leading to higher wages. This Federal Reserve, in terms of the market's expectations, are going to be, and they're going to be talking more hawkishly than a lot of people would like to see them perform. And that is going to drive up short-term interest rates. And that's a critical piece of our outlook longer term for the economy. Where is the inflation pressure coming from? Well, basically, in the COVID-19 environment, when our demand picked up here on the backdrop of all this stimulus, we squeezed out all the inventory from the economy. So now any single supply disruption results in a demand increase that then pulls up prices. And because prices are rising and they're rising on a sustainable basis, and we haven't seen prices rise for over 10 to 15 years, we're in an environment now where human resources is looking at the upward movement in wages or the upward movement in prices, and they're looking at evidence of a tightening labor market and advising CEOs that they're going to need to do something in terms of rising wages going forward into 2022. And it's that next step, that wage step, that we think happens between now and year end that juices the expectations of what the Federal Reserve is going to have to do. This adjustment in markets, however, we think will set the stage for the reality that the Federal Reserve will never be in a position to have to raise rates by time we get there in the second half of 2022. Why? Because of the longer term dynamics, which is what we're going to talk about now. And the COVID-19 environment did not change the longer term dynamics. What are those longer term dynamics? Those longer term dynamics are demographic. We have an aging population. And not only do we have an aging population, Japan has an aging population. China is aging right behind Japan in a very, very aggressive fashion. Europe is aging more quickly than we are. We have a global economy in the major industrialized power, or in the major key 48% of global GDP, Europe, Japan, and China, where we have significantly more aging populations than we have here, and we're 24% of GDP. So if you throw us all together, we're over 60% of global GDP is in an aging population environment. That means essentially we are going to be reducing demand over time, which means the excess demand situation we're experiencing right now because of the COVID-19 environment is not going to be long-lived. In addition to the situation in terms of the dynamics of the demographics, what else is taking place longer term? Longer term, there's excess supply of tradable goods. Going into the COVID-19 lockdown mitigation strategy I suggested, we had an unemployment rate that got to as low as 3.5%. At 3.5%, we still weren't able to achieve the Federal Reserve's 2% interest rate target. It's showing you basically that the world is living in a world of excess supply of tradable goods. We see this in the current account deficit, going from a deficit to expanding into a surplus following China's joining of the World Trade Organization. We see it in the growth in global trade that's taken place following China joining the World Trade Organization. And nothing we've seen in terms of the dynamics of what's taking place in China right now, which is going to lead to slower global GDP against an environment where we still have all the production facilities, because none of them were damaged or destroyed as a result of the COVID-19 lockdown environment. We are going to amplify the excess supply situation longer term. In addition to this, we have this Federal Reserve, as I suggested, that is really focused on being preemptive against an inflation environment. And the markets are going to assume that this Federal Reserve will tighten early and tighten more aggressively. That factor, the higher inflation being created from the short-term dynamics in an environment where demographics argues for excess supply, where evidence of excess supply exists in tradable goods across the board, in an environment where productivity has been expanded to compensate for the reduction in employment during the COVID-19 lockdown mitigation environment, we've created an environment basically in which excess supply will dominate long term. And that excess supply dominating long term is critical, because that tells you that long-term interest rates are not going to go up as quickly or as far as short-term interest rates are likely to progress. This is a critical piece of the equation. Long-term interest rates are going to be held down in a world of deflationary pressures because we have excess supply and there is a global demand for yield. And the United States is the source of yield. And in an environment where people anticipate a more aggressive monetary policy response from the Federal Reserve than from the other major central banks, the currency is going to go up as well. And as the currency goes up, the yield performance, the total rate of return performance by investors to go long the long end of the Treasury curve will increase. And the net result is the expectations of higher short-term interest rates will create an environment of a flatter yield curve. And a flatter yield curve is indicative of an economic environment that is going to slow. One thing I did not talk about at the beginning of this presentation, for a good reason, because I want to discuss it now, is what is my GDP outflow for the next couple of years? You know, when we sat down over a year ago and talked about what we thought we would see in 2021, we penned in a number of 5.8% GDP for this year. It's interesting that after being as high as 7.7%, the global forecast is now almost right on top of our number in that 5.8, 5.9 area. So the street has come down to our view for 2021. What about our view for 2022? Our scenario for 2022 suggested that basically the cyclical stimulus would fade And as a result of the fading fiscal stimulus, with or without the Build Back Better program, the fiscal stimulus is going to fade. And the net result is we're forecasting GDP growth of 3.5% for 2022. That contrasts to a consensus forecast today of 4.4% for 2022. Almost one whole percentage point still stronger than our number. And what are we anticipating for 2023? We're anticipating GDP to return to the pre-COVID-19 trend, which dominated throughout the entire post-financial crisis recovery of 2 to 2.25% growth. That's a significant deceleration in economic activity. It's a deceleration in economic activity that helps support our argument that the short-term cyclical excess supply situation will yield to the long-term excess supply and deflationary pressures, probably beginning in the second half of next year, which is why we have very little additional deterioration in long-term interest rates penned in for next year. Remember, my target for the end of this year is 1.5%. My target for the end of next year is 1.75%. In the interim, we believe the 2-year, 10-year spread will go to below 100 basis points from where it is right now at about 100 and 125 basis points. So that's a significant additional flattening in the curve as people roll in rate hikes that probably don't occur, but because they roll them in, they add to our forecast that the economy is going to decelerate. Where does this leave us? It leaves us basically in an environment in which expectations dominate over actual policy decisions. And as a result of that, the curve flattens and the dollar gets stronger. Long-term rates remain in a very, very stable, almost benign environment. And the equity market struggles over the balance of this year as these expectations of what the Fed is going to do will get discounted into the marketplace. And then as the inflationary pressures come off next year and the deflationary forces reassert themselves, even in a global slowing economic environment, the decline in interest rates at the front end of the curve will re-steepen the curve and set the stage for a very, very solid U.S. equity market performance for the S&P 500 next year of another year of double-digit growth in the U.S. equity market. I've talked for about 20 minutes at this particular juncture. It's a 30-minute presentation. I was given 20 minutes for the prepared discussion. If anybody has any questions, I'd love to field them. And I believe it's Megan who's going to be asking me the questions. Oh, hey, Bridget, you're back.
I'm back. And I'm avoiding any questions about aging population, Steve. That was great. That was a lot of information. Couple questions have come up. One question is obviously, talk about the U.S. and because we are the Global Business Alliance and the IIB, wanted to maybe expand that a little. What does all this mean, in your view, for the U.S. as an attractive investment for foreign companies? So it's all kind of relative, U.S. versus other countries. How do you think about that?
Well, I'm glad you asked the question, Bridget, and it really gets to the heart of the equation because what we're really implying here is the U.S. will continue to outperform a number of these other regions. I mean, take a look at a country like Japan, where my home company is domiciled. Japan has been struggling with deflation since the 1990s. They've got an incredibly aging population. Japan has done okay in terms of their people, in terms of the improvements. I don't know if any of you traveled to Japan. It's a very, very top-notch country in terms of the fit and finish of everything they do. But you have to remember, Japan is a net creditor to the world. So deflation tends to have less of an impact on Japan. It limits the growth. It limits the opportunities that can develop there, which is why Japanese companies continue to look at the United States as a place to expand. But again, they've been able to, keep it a very, very firm economy in terms of its own right. Although when you look at the last 10 years, for example, we had the longest expansion in America's history. I believe Japan went through 5, if not 6 recessions during that expansion. That's what happens when you fall into the deflation trap. When you look at Europe, Europe never really got out of the deflation trap after the financial crisis. And this has done nothing other than create even more excess supply in Europe. Again, and Europe has this environment of a much more rapidly aging population than we do. So again, the dynamics for the European economy going forward are that essentially they're going to be locked into the deflation. Now, where Japan is a net creditor, Europe is interesting because Europe is not always a net creditor. The core European countries are clearly net creditors, but the Club Med countries are really net debtors, much as ourselves. And that tends to be a dynamic problem in terms of Europe itself, in terms of the limitations of growth. And this is why you see the EU starting to fracture in many, many ways, not just in Brexit, but we're also seeing the discussion that's going on with Poland right now, because it's easy to all be coordinated and happy with each other when everybody's growing and growing rapidly. But once you start getting these dislocations in terms of growth, it becomes a greater problem. And this goes right home to roost in terms of China as well. You know, the Chinese economy is going through a massive restructuring right now, and it's real estate related market. It's a huge component of the overall Chinese economy. It's a bigger component of the Chinese economy than it was in the US when we went into the financial crisis. And they're just at the tip of the iceberg of what's going to happen there. And again, it's an aging population where in particular, you know, men retire at 55 and women retire at 50. So you've got this environment where China is going to be seeing its working age population squeezing very, very rapidly. And they have to find a way to keep on doing this. So overall growth is going to slow, but they need to continue to provide export markets. So I think China is going to continue to be an export market into the world rather than being a real demand component for the overall economy. The one place where you've got this real good mix of both demand and supply and intellectual improvement in property winds up being in the United States, combined with a very, very efficient capital market environment. And those really drive the motivation for foreigners to look to be involved in the U.S. economy.
That's really helpful. Thank you for that explanation and discussion. Wanted to get your thoughts on some pending, sort of policy issues. So you quickly mentioned that what you're forecasting in terms of growth and where interest rates are headed in GDP growth, that the proposed infrastructure bill and the Build Back Better wouldn't change that. And could you talk about that a little?
I'd be glad to. I mean, I think the infrastructure bill, the bipartisan bill, has a lot of good things in it, clearly, in terms of what we need in terms of infrastructure, physical infrastructure of roads, bridges, and tunnels. And I'm not going to criticize the aspect of a social infrastructure aspect of the Build Back Better program. Clearly, it is a debate that America needs to have. It's something America needs to decide upon. You know, the Lyndon Johnson Great Society experiment started this process, and we're essentially moving further along the process and have been moving further along the process over the past few years, even with the Obamacare-related legislation that came through as well. What really is important to me in terms of assessing the macroeconomics of this is a lot of what we're doing here is extending programs which are already in place and going to sunset fairly soon. And therefore, from a spending level, the programs we're going to advance really do not add much to the stimulus aspect of the economy from what we can tell. Okay, again, we haven't seen the legislation. I don't know many people who have seen the legislation. I'm not sure a lot of politicians have really read the legislation yet. But there's also going to be a tax side of this equation. And for me, the tax side of the equation is an additional net negative. Because if we don't get anything from spending, but we're actually increasing taxes, what we've learned from history is that the negatives tend to come through before the positives. And if the positives are limited to just sustaining programs which are already in place, but we're going to add a tax on top of it all to help pay for extending these programs, then that winds up being a net drag on the economy in the near term. And that's one of the reasons why we're so convinced and have been so convinced that growth will go slower over time and as quickly as we're talking about. To get to my 3.5% GDP number for next year, it implies that second half growth for next year will be in that 2 to 2.5% category. And so therefore, it's a function of those programs beginning to impact.
Got it. That's a great segue to a attendee question here. Another one that's focusing on expectations. And you had mentioned that sort of market expectations almost overtake actions that the Fed might take. So the question is, would there be messaging or signals that the Fed and or Treasury might give that would change that? Or is the market just pretty set in their thinking about this?
That's a great question. We have trained markets since Paul Volcker and then through the Alan Greenspan years where we went specifically to a preemptive style of monetary policy. So, almost all market participants, other than the old ones like me, which is why, again, I don't like talking about the demographic issues here either, Bridget. We remember a time where this wasn't the case, but in the environment where most people now have grown up, this is all that's there. And this is true in particular for market participants. So when they see a spike in inflation like the one we're experiencing now, even though I can lay out a very cogent argument as to why these are short-term cyclicals and why they will not dissipate, this is an anomaly to most of these market participants, and to them, that anomaly needs to be dealt with. And to a great extent, if the Fed were to come out forcefully against dealing with it, the markets may push even quicker. It may not be at the front end of the curve, but it would be at the long end of the curve. So by the Federal Reserve having gone back to a preemptive style in June, July of this year, from the more Keynesian profile, reactive policy that they implemented back at the Jackson Hole, Kansas City Fed Symposium in August of 2020, we're in an environment where market participants have been holding long-term rates down, which is a benefit for the housing economy, which is a key component of the underlying health of the U.S. economy. And it's one of those things that helps people move through our class system. I shouldn't say our class system, but through the economic classes based on income, and as you move up the chain of income, you begin to grow your asset values by having a one-family home. And by keeping long-term interest rates low, by being preemptive, the Federal Reserve is helping that. So to some extent, if you were to try to hold short-term interest rates down, you're going to be damned if you do, damned if you don't. So you might as well stick with a recipe that's been proven to be successful before in the longer term.
Turning back to the more international questions, what role does trade policy play in any of this? You briefly touched on China. I think maybe there were expectations that there might be changes in trade policy. That doesn't seem as clear, but I guess even more importantly, what matters is what people expect. Any thoughts on that?
Well, I think part of the problem that we're experiencing here in the U.S. is that, if you are going to use an industrials policy to expand domestic production, you're going to have to do it in an environment where you have to be willing to accept higher inflation. Or you have to do it at the point in time at which the economy is experiencing the excess supply, not the short-term cyclical boost. And that excess supply deflationary environment gives you the cover to do an industrials policy to expand domestic production. Attempting to do it now during this cyclical period of excess supply, I think would be a mistake. I think if we had done it a year ago, 2 years ago, we would have been expanding, or we would have been enjoying the benefits of that today, i.e. we'd be less dependent on long supply chains, port-related issues, containers being in wrong locations, costs of containers going up. We'd be less dependent on that now if we had done it before, but we didn't. So now is not the right time to do it, because now we're struggling with the short-term supply-related dynamic and demand-related dynamic.
Great. Another question, you had mentioned that you expect U.S. economic growth to fall below the 3% by 2023. What factors, and I assume this means, both maybe policy, but economic factors could change that up or down?
Well, I mean, it's interesting to change it up in a world where we have a lot of debt. And it's interesting that, Japan fell into its deflationary cycle when non-financial debt to GDP got to 250%. When you look at the whole world now, other than Germany, it's basically at 250% debt to nominal GDP. And you look at the whole world now, it's very, very hard to sustain above trend economic growth because of this level of debt that's outstanding in the system. That's number one. So unless we do something to rationalize the debt-related weight that's sitting above the global economy, and in particular the U.S. economy, it's going to be hard to be able to do that. Turning back to the concept of bringing back domestic production so that a surge in demand is not reflected in a reduction in inventories or a surge in the trade deficit is also something that we have to consider longer term. But that industrials policy is really not on anybody's game plan at this particular juncture. And it really should be, because you have to start considering what you want to do now so that when the global excess supply situation reasserts itself, you have a program to go forward. I'm afraid the political dynamics are going to keep that from happening as we go forward into the upcoming election. So therefore, I think, again, that's another lost cause. The other things that can happen would be a great new technological revolution. The digital revolution took quite some time to manifest itself in a very, very robust, growing economic environment. Is there an alternative to that right now? Is AI that scenario? And we're still not fully recognizing how powerful that could be to stimulate longer-term economic growth above trend without creating inflation, which is basically the best of all worlds scenario that Alan Greenspan faced back in the last two terms of his chairmanship. Again, we don't know that. We don't know that ahead of time. You certainly hope there is something like that out there, but I don't see it right now. And I honestly don't see that the push towards green technologies are going to be the thing that gives that to us, because there are all sorts of negative externalities that unfortunately have come about as a result of it. And we have to deal with those. I'm not arguing against the push towards green. I'm just saying, there are unintended consequences to a lot of the things we do. And unfortunately, we've learned throughout time doing this job that most unintended consequences are negative. And when you try to do two things at the same time, the unintended consequences both tend to be negative, and they tend to be positively correlated, which means you wind up with more than the value of two unintended consequences weighing on the economy. So therefore, with what we're trying to go through right now, I think, we need some period of policy stability to allow us to work through the negative unintended consequences and let the economy resettle back towards where it should be going.
So back on that's you brought up an interesting point, maybe to talk about that a little bit more on financing the transition, technological, sort of investment in renewables, batteries, other things that would help. Talk a little bit more about how, sounds like you don't think that that's going to be a game changer in terms of economic growth. Did I understand that?
I don't think it's a game changer in terms of economic growth. Is it a game changer in terms of the economy? Is it a game changer in terms of the environment? Sure, that's all possible. Mm-hmm. But is that transition going to lead to positive long-term growth? Remember, whenever you're trying to make these major structural change in the economy, there are legacy industries. And those legacy industries wind up being hit the hardest. And the cost factor of dealing with those legacy industries tend to be what happens initially. And therefore, the gains come later after we've recognized those problems. If you suddenly move every car in America to an electric vehicle, look at all the plant and equipment we have created out there for internal combustion engines. Somebody has to eat the cost of that. And that tends to be the drag on the economy. So there are transactions costs, so there are transition costs involved that, yes, the longer term goal may be exactly where you want to get to, but you can't ignore the short-term implications of what you're doing.
So speaking of short term and sticking with this, question about the semiconductor shortage and what, I guess, short and long term you think that what kind of impact that's going to have.
Well, I mean, the reality is we will get through this. I mean, if you go back to the origination of this whole problem, it started as a result of an unavailability of the resin that allows us to make the silicon. And the silicon's necessary to make the chip. So if you don't have the silicon, you can't make the chip. You can't run the chip fab. If you can't run the chip fab, you can't make the chips. You can't put it in the cars. If you can't put it in the cars, you can't make the cars. So yeah, this is a clear example of a supply chain related constraint. The result of this is, yes, we've seen more influence, more intended investment taking place in producing more and more, chip fabs going forward. But again, we need those underlying raw materials in order to make the silicon, to make the chips. And that's really an important consideration, which, forgive the expression, it's not a sexy component of the overall macroeconomic environment, but at the end of the day, it's the fundamentals. And without it, the rest of it doesn't work.
We have a question, and you addressed this generally when you talked about, deflationary markets. But the question maybe for the non-economist of us, we'll go at it again, round two, stagflation. Do you think it's likely? I mean, what's your prognosis?
The perception of stagflation is highly likely, which is what generates the expectational set that dominates the flattening of the yield curve, that leads to the slower economic growth, that leads to the near-term concerns about the equity market, that also leads to a sustained low long-term interest rate environment. That's fundamentally important. Can we create a real stagflation environment? Here, I think the answer is no, because there's no linkage between wages and prices. That is a loop. What happened in the 1970s was a combination of many factors, none of which we have today. We had a world of excess demand coming out of World War II. We had the baby boom generation moving into the labor market and beginning to form households and having the baby boom echo that they created, who are now the millennials, who are probably a lot of the audience watching here today. In addition to that environment that we had unfolded, we had a highly unionized economy. And union contracts were loaded with cost of living adjustments. So if prices went up, wages automatically went up. So when wages automatically went up, companies had to raise prices even more. But then that turned right back around and kicked up wages again. And it was a self-fulfilling spiral. And Paul Volcker had to create a ridiculous collapse in economic demand to break that spiral. I.e., it also happened at a unique time where Ronald Reagan had begun giving the impetus towards companies to begin breaking up and busting unions in that environment when he fired the air traffic controllers. We've had a unique set of events that created that wage price spiral and stagflation that dominated the 70s and still dominates the thinking of most policymakers, in particular on Capitol Hill, and very much so at the Federal Reserve, because that is the world in which we all grew up. That's the world we all studied. That's the world we all know. And that's what we're all frightful of having happen again. But without that union contract component, with a shrinking population, with a world of excess supply, I don't see how you can generate that. And keep in mind, we just went through an exercise earlier this summer where we tried to unionize the warehouse, one warehouse of the richest company in the world, owned by the richest guy in the world. And we couldn't even unionize his warehouse.
That is a great, this is a great note to end on, because it was a history lesson and an economics lesson. And that's always doubly interesting. So thank you. Any last remarks you want to make, Steve, before we close it up? You've been really gracious with questions in your time.
No, I think we've covered, a good deal of it. I do think that the the reality that we think about going forward is we have to keep in mind the expectational sets that really move markets, and what we try to do from a policy side, whether that's actually going to influence positively or negatively that expectation set. And that's really the fundamental point. I think of all the questions we discussed, that's the one that I think for, the people in the room or the people in the virtual audience room, that's the important point. What we think we want to accomplish may create an unintended consequence, which goes 180 degrees away from what we want to do, which is kind of what our program of robust fiscal stimulus did, in terms of we wanted to do this good thing, keep the economy from suffering as much as it could as a result of the COVID-19 lockdown mitigation strategy. And what we created was a cyclical supply shortage that has resulted into an inflationary environment that we haven't experienced in 10 plus years. That's the unintended consequence.
That's a great wrap up, important consideration for all of us. Really appreciate, again, so much your time. This has been a great inaugural event for the Economic Advisory Council. For our attendees, Steve and David Lander's contact information is going to pop up here on the screen. They've been very kind to say they're happy to take additional questions. This is your maybe chance for some free economic analysis. Thank you for joining us today, and stay tuned for our next installment. Thank you so much. Nancy, thanks, and be well.